Since the beginning of human civilization, gold has held a magnetic pull over people's imaginations, fear, and ambitions. What once functioned as a symbol of wealth and power in ancient kingdoms has now resurfaced as one of the most intriguing financial trends of the 21st century. As 2026 draws nearer, a growing number of billionaires are quietly increasing their exposure to gold. And the narrative around this precious metal has shifted dramatically from the dusty corners of traditional investing to the forefront of global financial strategy. While most everyday investors chase stocks, cryptocurrencies, or real estate, the ultra-wealthy, those with access to sophisticated data, insider insight, and macroeconomic forecasting are beginning to embrace gold not as a nostalgic artifact, but as a calculated strategic asset in a world filled with uncertainty. What lies behind this quiet accumulation? Why are some of the richest individuals on the planet reverting to a metal that, for centuries, was the backbone of monetary systems? And what lessons can be drawn from their actions in a world still reshaped by economic volatility, geopolitical risk, and the rising specter of inflation? To understand why billionaires are increasingly pivoting toward gold, it's important to first recognize that their investment decisions are rarely driven by short-term emotion or guesswork. These are individuals whose decisions are deeply informed by global dynamics. They consult world-class analysts. They have access to confidential economic forecasts, and they are often early adopters of strategies that later filter down to the broader public. For them, gold is not merely a collectible or a hedge against inflation. It represents stability in a world that financial markets increasingly describe as unstable. At the heart of this shift are three key economic realities: inflationary pressure that refuses to dissipate, gargantuan public debt levels in major economies, and rising geopolitical tensions that threaten to upend global trade, supply chains, and confidence in fiat currencies. Despite central banks' repeated assurances that inflation is under control, many economists and investors argue that the underlying pressures have simply changed form rather than disappeared. Prices of essential commodities have seen persistent volatility. Energy markets remain unpredictable, and food prices in many regions continue to outpace wage growth. For the ultra-wealthy, these conditions signal deeper structural risks to purchasing power. Gold, with its centuries-proven ability to retain value even when currencies fluctuate, begins to look less like a relic and more like a necessity. Billionaires, who have historically relied on diversified portfolios of equities, bonds, and alternative assets, now see the value in having a portion of their wealth outside the reach of traditional financial instruments that are heavily influenced by central bank policies. They are effectively safeguarding part of their fortune against scenarios that could devalue paper currencies or erode confidence in conventional markets. Public debt is another critical factor driving this renewed interest in gold. Across the world, government debt levels have ballooned to historic highs. Countries like the United States, Japan, many in the European Union have expanded their debt portfolios in an unprecedented way, largely in response to economic slowdowns, pandemic stimulus spending, and social welfare expansion. While governments argue that this debt is manageable, many private investors see it as a ticking time bomb. The fear is not merely that governments will default, but that the only feasible solution to growing debt burdens may lie in inflationary tactics, devaluing currencies to reduce the real value of what is owed. If such a strategy is employed on a grand scale, fiat currencies would lose purchasing power over time, potentially triggering a wave of inflation that erodes savings. In such an environment, each of these developments introduces uncertainty into the global economic system, uncertainty that often drives investors towards safe haven assets. Gold, because it is universally recognized and has intrinsic value regardless of political boundaries, becomes exceptionally attractive. When stock markets waver, economies slow, or diplomatic relations sour, gold typically retains or even increases its worth. This makes it an ideal counterbalance within a diversified investment strategy, especially for those whose wealth is tied to international markets and multinational operations. In addition to central bank activity, geopolitical tensions have heightened the appeal of gold as a portable, universally accepted store of value. Escalating conflicts in resource regions, trade disputes between major powers, and uncertainties surrounding global supply chains all feed into the calculus of risk. Gold, unlike other forms of wealth, is not contingent on national borders, banking systems, or digital infrastructures. Its portability and liquidity make it an especially attractive asset during periods of instability, as it can be moved, stored, or converted with relative ease. For billionaires, the ability to relocate assets across borders quickly is an essential safeguard against unforeseen crises, including political unrest or sudden regulatory changes that could freeze conventional financial assets. One of the more intriguing implications of this accumulation is its potential impact on global markets. While the moves are currently discrete, the sheer scale of purchases by the ultra-wealthy has the capacity to influence gold prices indirectly. Large acquisitions can tighten supply, particularly of high-quality bullion in collectible forms, driving up market prices even before broader economic conditions shift. This effect can create a feedback loop. As prices rise, media coverage and analyst reports often highlight increased interest in gold, prompting additional demand from institutional investors and well-informed retail players. In this way, the quiet strategies of billionaires can quietly set the stage for broader market movements, a phenomenon largely invisible until it reaches critical mass. Tax considerations and legal frameworks also contribute to the methods of acquisition. Many billionaires take advantage of tax-efficient structures, such as private trusts or foreign holding companies, to manage their gold assets. These structures are carefully crafted to minimize exposure to capital gains, inheritance taxes, and other financial obligations while maintaining full legal ownership. Such arrangements require meticulous planning and access to top-tier legal and financial expertise, reinforcing the fact that gold ownership at this level is far from a casual hobby. It is an intricately orchestrated component of wealth preservation and intergenerational strategy. Importantly, this movement toward gold is not a rejection of modern finance, but a complement to it. Billionaires continue to hold diversified portfolios that include equities, bonds, private equity, and alternative investments. Gold serves as a stabilizing counterbalance within these portfolios, offering protection against risks that traditional assets cannot fully mitigate. It is precisely this combination of old-world stability and modern financial acumen that makes the strategy particularly compelling. While stocks may fluctuate based on corporate performance and bonds may suffer from interest rate changes, gold provides a constant benchmark of value, immune to many of the forces that affect paper-based investments. Finally, the human element cannot be underestimated. Billionaires are not just responding to numbers and forecasts. They are also responding to history. The collective memory of financial crises, currency collapses, and global wars informs their behavior. From the hyperinflation of the 1920s in Germany to the 2008 financial crisis, wealthy individuals have observed that gold consistently retains value when conventional systems fail. This historical awareness, combined with sophisticated forecasting, makes gold an almost instinctive choice for those seeking to shield wealth from unpredictable future events. In essence, the quiet accumulation of gold is both a rational financial maneuver and a form of historical insurance, a way to navigate uncertainty while honoring lessons learned from past upheavals. As we move closer to 2026, the strategies outlined here will likely intensify. Billionaires' gold holdings will not only reflect economic and political realities, but may also serve as a harbinger for market trends to come. In Part 3, we will explore how these private acquisitions could ripple across global financial systems, influence asset prices, and affect everyday investors who are only now beginning to notice the quiet but powerful shift in wealth toward gold. As the quiet accumulation of gold by billionaires continues, the implications of this trend begin to extend far beyond the private vaults of the ultra-wealthy. While the strategy itself is discreet, the ripple effects are increasingly evident across global financial systems, commodity markets, and even political landscapes. One of the first areas affected is the global gold market itself. Unlike typical investments in stocks or bonds, the supply of high-quality gold is inherently limited. Mining output cannot increase instantaneously to meet demand, and historically, significant surges in purchasing by a concentrated group of investors have created price pressure. What might initially seem like a marginal accumulation becomes a broader catalyst for upward movement in gold prices, particularly as institutional investors and hedge funds observe these trends and adjust their strategies accordingly. The quiet purchasing by billionaires, therefore, has the potential to subtly reshape market dynamics long before the general public becomes aware of the shift. This effect is compounded by the interconnected nature of modern financial markets. Gold is not merely a commodity. It functions as a benchmark for stability in portfolios, a hedge against currency depreciation, and a tool for risk management across asset classes. As billionaires increase their allocations, fund managers, pension funds, and insurance companies often respond indirectly, incorporating gold into their own strategies to mitigate risk exposure. This creates a feedback loop. Rising prices and growing institutional interest attract even more buyers, which in turn further tightens supply. In effect, the ultra-wealthy are quietly influencing global investment behavior without public announcements or media fanfare. For retail investors, this phenomenon often appears sudden and unexpected. But in reality, it is the culmination of strategic accumulation that has been ongoing for years. Another area of impact is on currency markets. Gold is intrinsically linked to perceptions of monetary stability. Large-scale accumulation by billionaires signals a lack of confidence in fiat currencies. When high-net-worth individuals diversify into gold, particularly in a discreet and substantial manner, it can create subtle pressure on national currencies. Traders and analysts may interpret this behavior as a warning sign of potential devaluation or inflationary trends, prompting adjustments in exchange rates, interest rates, or hedging strategies. For countries with significant public debt or economic vulnerabilities, these signals carry real consequences, influencing policy decisions and international negotiations. In this sense, gold is no longer merely an asset class. It becomes a tool of influence, shaping financial behavior and policy at the highest levels. The political dimension of gold accumulation is equally compelling. Throughout history, nations and influential individuals have leveraged precious metals as a form of security against global uncertainty. Today, billionaires are effectively continuing this tradition, but on a private scale. By holding gold outside the reach of any one government or banking system, they gain a level of autonomy that offers protection from political risk, sanctions, or economic instability. In a world marked by rising geopolitical tension, whether trade disputes, conflicts over resources, or shifts in global alliances, such autonomy provides not only financial security, but also strategic leverage. For multinational entrepreneurs and investors whose operations span multiple jurisdictions, it's the ability to safeguard assets in a universally recognized medium becomes a form of political insurance, allowing them to act with confidence even amidst global turmoil. The ripple effects of gold accumulation extend into corporate strategy as well. Companies with billionaire stakeholders or founders often mirror these investment philosophies, adjusting their own reserves and treasury management practices to align with the perceived risks highlighted by gold trends. Some may increase corporate gold holdings, diversify cash reserves into precious metals, or hedge against currency volatility in ways that echo their individual owners' strategies. This cascading effect transforms gold from a personal hedge into a corporate safeguard, creating layers of influence that permeate through broader economic structures. Essentially, the ultra-wealthy are not only protecting themselves, they are indirectly shaping the policies and risk management practices of major corporations worldwide. Beyond institutional and corporate implications, the psychological effect on public perception is significant. While billionaires acquire gold quietly, reports of their activity inevitably reach financial media, analysts, and observant investors. Once the narrative spreads, retail investors often react, sometimes amplifying market movements. The knowledge that billionaires are accumulating gold can create a sense of urgency or fear of missing out, prompting wider buying in ETFs, coins, and other gold-related instruments. This phenomenon demonstrates the intersection of information, asymmetry, and market psychology. Those with privileged access act first and benefit most, while broader markets respond later, often exaggerating the effects. It is a clear example of how private strategies can trigger public financial behavior without overt signaling. The timing of this accumulation also underscores the strategic foresight of the ultra-wealthy. With 2026 approaching, many analysts are projecting potential stress points in the global economy, rising inflation, central bank tightening, sovereign debt challenges, and uncertain geopolitical conditions. Billionaires, through their private advisors and global networks, are positioning themselves in anticipation of these potential crises. Gold, with its historical role as a hedge against systemic shocks, becomes a central element in this preparation. Unlike equities, which may fluctuate dramatically with market sentiment, or bonds, which are tied to government solvency, gold maintains intrinsic value regardless of external shocks. This timeless stability, combined with strategic timing, allows billionaires to navigate uncertainty while preserving generational wealth. Furthermore, technological and financial innovations have amplified the accessibility and utility of gold for high-net-worth individuals. Private digital vaults, secure online trading platforms, and blockchain-based verification for physical gold ownership enable billionaires to monitor, manage, and transfer holdings with unprecedented efficiency. These innovations not only enhance security, but also allow for complex financial engineering, fractional ownership, leveraged exposure, and cross-border asset movement without the limitations faced by average investors. The integration of technology into traditional gold acquisition illustrates how ancient assets can evolve to meet modern financial needs, bridging the gap between old-world stability and 21st century sophistication. Despite these advantages, the quiet accumulation of gold is not without potential risks. Market liquidity, global supply constraints, regulatory scrutiny, and geopolitical developments can all affect the value and accessibility of gold. And pairing physical gold with derivative instruments, they effectively create a multi-layered shield against uncertainty. This meticulous approach contrasts sharply with retail investors, who often approach gold with reactive strategies rather than long-term planning, highlighting the gap between sophisticated and casual investment practices. Ultimately, the billionaire's quiet accumulation of gold signals more than just a hedge against economic uncertainty. It represents a profound understanding of wealth preservation, market influence, and strategic foresight. By aligning historical insight, financial acumen, and technological tools, the ultra-wealthy are not merely buying a commodity, they are crafting a resilient position that shields them from foreseeable turbulence while positioning themselves to capitalize on market shifts. This pattern, while subtle in execution, has far-reaching implications for markets, investors, and policymakers alike. As we reach the final part of this exploration, it becomes clear that the quiet accumulation of gold by billionaires is not a fleeting trend, but a window into how the ultra-wealthy prepare for an unpredictable future. While their strategies are complex, the implications for global markets, governments, and everyday investors are profound. The very act of acquiring gold discreetly, strategically, and in significant volume sends signals that extend far beyond the confines of private vaults. It reflects a broader anticipation of economic turbulence, shifts in geopolitical power, and a reassessment of how wealth is preserved in an era of uncertainty. Understanding these implications is essential, not just for high-net-worth individuals, but for anyone seeking to navigate the financial landscape as 2026 approaches. One of the most significant takeaways is that gold acts as both a hedge and a stabilizer. In the portfolios of billionaires, it functions as a counterbalance to assets that are more vulnerable to systemic risk, such as equities, real estate, or corporate debt. By maintaining a proportion of wealth in a universally recognized and finite asset, these investors protect themselves from sudden shocks, whether triggered by inflation, currency devaluation, or geopolitical conflicts. The strategic positioning in gold provides liquidity, security, and a measure of predictability, even when markets are in chaos. In essence, it is a form of financial armor, allowing billionaires to weather storms that might devastate conventional investment strategies. For the everyday investor, the actions of billionaires offer critical lessons. First, diversification remains paramount. While it may not be feasible for retail investors to replicate the private vaults, offshore holdings, or complex derivative strategies employed by billionaires, the principle of spreading risk across multiple asset classes holds true. Gold, even in smaller allocations, can serve as a stabilizing component of a broader investment strategy. Billionaires' moves are rarely reactive. They are the product of careful forecasting, historical insight, and a keen understanding of systemic risk. Investors who prioritize long-term strategy over short-term gains are more likely to navigate periods of volatility successfully. Third, information matters. While ordinary investors lack the insider networks available to billionaires, staying informed about macroeconomic trends, global conflicts, and central bank policies can provide valuable context for making strategic decisions in any portfolio. The accumulation of gold by billionaires also carries potential implications for global financial systems. As wealth concentrates in a tangible asset outside the reach of conventional financial institutions, there is a subtle shift in the balance of influence. Governments and central banks, which have long relied on control over currencies, interest rates, and debt instruments to manage economic stability, now face a scenario in which a portion of global wealth is effectively insulated from these mechanisms. While this does not pose an immediate threat, it signals a gradual redistribution of financial power, wherein private actors can exert significant influence through strategic asset allocation. Such dynamics may prompt shifts in monetary policy, trade negotiations, and financial regulations, especially as the approach of 2026 heightens concern about economic vulnerabilities. Another key dimension is the effect on market psychology, even as billionaires maintain discretion. The mere knowledge that high-net-worth individuals are acquiring gold can influence the behavior of other investors. As mainstream media and financial analysts report on trends in gold accumulation, retail and institutional investors often respond by increasing demand, creating upward pressure on prices. This phenomenon, sometimes referred to as informational cascades, illustrates how strategic moves by a small, informed group can create ripple effects throughout the broader market. Understanding these dynamics can empower everyday investors to recognize patterns, anticipate potential shifts, and make decisions with greater awareness, rather than reacting purely to market hype. The geopolitical dimension also cannot be ignored. Gold is a universal asset, recognized across cultures and borders, and its portability ensures that it is relatively immune to political risk. For billionaires with international interests, the ability to move or store wealth in gold provides a layer of protection against sudden policy changes, sanctions, or conflicts. In an era marked by increasing tension between major global powers, disruptions to trade, and instability in key regions, gold offers a level of independence that other assets simply cannot match. This strategic flexibility has profound implications for wealth preservation and long-term planning, emphasizing the importance of tangible, universally valued assets in a complex world. As we synthesize these insights, it becomes clear that the quiet accumulation of gold by billionaires is both a reflection of the challenges ahead and a lesson in strategic foresight. It underscores the importance of thinking beyond short-term market performance, considering historical precedents, and preparing for scenarios that may seem improbable but carry catastrophic potential. It is a safeguard, a hedge, and a tool for navigating uncertainty. For billionaires, it is a critical component of a carefully orchestrated strategy designed to preserve wealth, maintain autonomy, and mitigate risk in a rapidly changing global environment. For those watching these developments, there are actionable takeaways. Consider your own portfolio. Are you prepared for potential currency fluctuations? Diversification, research, and long-term planning are more than buzzwords. They are the principles that guide the investment strategies of the wealthiest individuals on the planet. While retail investors cannot replicate the private vaults and sophisticated structures of billionaires, even modest allocations to tangible, historically resilient assets like gold can provide meaningful protection. Awareness, adaptability, and strategic foresight remain the most valuable tools in navigating the uncertainties ahead. In conclusion, the quiet accumulation of gold by billionaires as 2026 approaches is far more than a curiosity or a speculative trend. It is a reflection of historical awareness, strategic planning, and risk management at the highest level. From private vaults to diversified asset strategies, these investors are demonstrating a profound understanding of how to preserve and grow wealth in an unpredictable world. The ripple effects extend into markets, corporate strategies, policy considerations, and even investor psychology. Thank you for watching this deep dive into why billionaires are quietly buying gold. If you found this video insightful, don't forget to like, share, and subscribe to the channel for more videos that reveal the hidden strategies shaping global finance. By staying informed, you can gain a clearer perspective on the trends that the ultra-wealthy use to protect and grow their wealth, insights that might just help you make smarter financial decisions in the years ahead. Remember, the world of finance is constantly evolving, but understanding the moves of those at the top can provide a unique advantage.